Hi folks, this is Doc Severson for the Theo Night Report for Tuesday, July 12th. What I've got to start us off tonight is basically about the last 100 years of the S&P 500. Now this is a linear scale chart, and you can see really the volatility changed into a different gear as we got into the mid to late 90s and just started really ripping. And we really kept this type of volatility ever since. And especially now where we have fleets of helicopters dropping money everywhere, I think this is the new normal. We're going to have this type of volatility going forward. We can always set up the chart for a log scale and kind of normalize this volatility. But the first thing that I want to really bring to your attention here is this notion about resistance at former highs. Now, I don't know where this is ever taught, but generally, this is sort of the prevailing conventional wisdom, is that when we have a former high like this and the price approaches that we instantly get rejection from that level and it's never able to get through that level again. Well, if we look back basically over time, over the last several decades, we can see that this really is not the case, is that former highs are quite easily blown through again and again and again. And so this is kind of what we have to deal with right now. So right now we are blowing into all-time new highs, and we've got a lot of folks that frankly aren't handling it very well, are not thinking that this is even possible. Well, first of all, let's zoom in on this area here and show how this worked out. So you can see that in this case, the former highs from 2000 actually did kind of hold around 2007, but then when the price had the temerity to come all the way back up to here in early 2013, it blew on past that level like it didn't even exist. And more recently, what we've been doing is kind of flirting around this 2100 level for quite some time and offering overhead resistance. Well, guess what? That just got blown through as of the last few days here. And so again, we've got people that don't believe that this is happening, are angry or upset that the fact that resistance didn't hold. Well, guys, I think what we saw over the last year and a half was, instead of a market which was going on pretty much a beeline to the upside, normally what we see in a situation like that is we see an equal and opposite correction to the downside, usually something around 20% or much worse than that. Instead, what we got was basically several mini corrections of less than 20%, and actually took much longer to do than if it were just to go back down from whence it came. So you could say that yes, monetary policy has kept kind of a floor underneath this market down here at about 1800 on the S&Ps, and that's certainly been the case. So yes, while I do agree it would be cleaner to have more of a traditional type of correction, and something like that would have looked like, well, one of these bear markets would have actually functioned quite well for that. So we would have perhaps come down to maybe the 1500 or 1600 level. And actually, I was kind of hoping for something like that, as it would mean that a lot of assets which had been inflated over the last few years would then be on sale, and we could perhaps be selling puts somewhere down in this level here, which would be a very attractive level to buy the S&P in 2016. Well, ultimately, it doesn't look like that's going to be happening right now. Really, the issue is around the world, we're going into negative interest rates. We've got Japan and now perhaps Great Britain firing up the fleet of helicopters ready to dump cash out there. And where do you think it's going to go? It's going to go to pretty much the only place in the world, just like a vacuum, where we've got yield. So it's going to come in from all different sources around the world looking for some sense of yield, whether or not they're through dividends or whatever have you. Even the low bond rates that we currently have and the low yields are still higher than many of the ones you find around the world. So this is why we have all of this cash coming in, and this is why we basically have markets breaking higher. Okay, so let's switch over to the spiders or the S&P 500 ETF here. Now, At $215 a share, this is not exactly a bargain basement ETF. I mean, we were trading against the S&P with using the SSO, which is more of a leverage ETF. It's a little bit more bang for the buck. And so we were, for most of this rally here, from 2009 on, we were trading against the SSO, and this was a great instrument to be able to sell puts against. You know, when it was at $10, $15, $20 a share, but now it's up to $70 a share. Is this really a bargain? And this is kind of the question that you have to ask yourself if you're going to do something like cash secured puts, covered calls, start to build up a long inventory. So if we're going to make the case that perhaps we have higher prices coming down the road, again, this is not necessarily my forecast for anything, but right now the price is starting to break out from a long-term consolidation pattern. So is there anything on sale right now, since we're apparently not going to get a pullback anytime soon? The latest one that we got was based on the Brexit, and we're already 10 points up on the SSO, or looking over at the S&P 500. The S&P 500 is actually over 100 points. So we dipped down to just below 2,000, and now we're over 150 points above that dip. So one of the first things I hate to do is chase after highs. So let's look around at the various S&P sectors and see if anything is for sale here, or at least at a distressed scratch and dent price. So what I'm going to do is just go through the 9 S&P sector spiders. So we'll look at the XLB first of all. This is materials, and this one is starting to work on to an uptrend again. So after the end of 2015 and the sell-offs that we had early on in 2016, we've now established this to an uptrend on the weekly chart. So we can certainly pursue trades within here if they do set up on the builders, although not much room left before it does run into all-time highs on there. Now, the XLE is probably the number one value sector. In other words, it has really underperformed for the last year and a half now, almost 2 years. Yeah, it's about 2 years we're running on here. So once I start to see the energy sector here starting to run higher and above, and on an individual stock basis, some of these are already above this pivot here. So right now, what's still happening is we're still in a primary downtrend on the monthly chart. So this one is still a little risky going after bottoms in this one. But if we do establish something where we put in a significant higher low and then that clears to the upside, then this might be worth going after as well. But right now, we'll look to see if any sectors or any stocks within the sector have actually cleared that high. Financials is another one with a tremendous amount of potential right now. So we still have financials are pretty much in this huge, symmetrical triangle here. So this is just a very, very large consolidation pattern. If we do see this break out to the upside from here, if we see this break out to the upside on the XLF, then these are fair game as well, and we have plenty of room up here. The problem is that between Dodd-Frank and 0% interest rates, financials don't have a lot of room to work with. So they've effectively been hamstrung ever since the financial crisis, and trying to find ways to provide margin for that, margin and earnings. So it's been tough. It's been a tough environment for them. And we'll see whether or not they're able to adapt to this new normal, because I think it's going to remain like this for a long time. But you can think of this as pretty much the same thing that NASDAQ stocks went through back in 2000, where they got thumped, but eventually did recover to fill in that entire triangle. And so I would assume that eventually financials will get a little bit of space and room to work with, and have a little bit more margin in the spreads to be able to work with, especially if the Fed is able to engineer a rate hike by the end of the year. Here's the industrials, the XLI. This is pretty much a carbon copy of the Dow chart, and not much to be seen here. Again, we could run much, much higher from here. I just don't consider these to be necessarily a bargain right now. Here are technology stocks, the XLK, once it comes up. And while these aren't exactly at bargain basement prices like they were at the financial crisis here, You can see that these have quite a bit of room to run before they get to all-time highs. Okay, next in the line is consumer staples, and these have absolutely exploded. So I would definitely want to see some type of pullback from these. A lot of these stocks that are in this group offer dividends and are seen as very, very defensive. So this has been catching a lot of yield lately. So right now I'm definitely not on a bargain level, as are the utilities, XLU. So neither of these, again, paying a lot of dividends for these. This is why they're catching such a bid. Here's XLV, which is the healthcare stock. So I would definitely love to see healthcare execute some type of pullback in here. Maybe some indecision around the administration change would be good for XLV to be able to get into a better entry on this one. But right now, no dice. And then, of course, we have XLY, which is consumer discretionary, which is a lot of people buying stuff that they don't need right now. Again, a lot of dividends behind these, a lot of demand for these types of stocks right now. So they've been holding their value really nice, but no real bargains here. So really, our sectors of choice to find bargains in right now are going to be still the financials and energy. So we're going to start to focus on those in the near term and see if we can find any value in those areas. So again, I think today's action is one more reminder of trade what you see and not what you think. There's a lot of folks out there that think that prices should not be at this level and don't deserve to be at this level, et cetera, et cetera, et cetera. But we can take those arguments all the way to a closed account if we take them too hard. So again, I'm just trying to trade what I see and not think too hard about it. Now let's just see if we can find something that's worth buying at these levels. So with that, thanks for listening, folks. And Don will be back through the Theo Night report tomorrow. Thanks for listening. See you soon.